Everyone, welcome to a new episode of Investing Fool. It's the middle of August, so in today's video we'll be doing the mid-August rebalancing. Lots of changes in the portfolio, so please watch the video till the very end. If you're joining the channel for the first time, we have been tracking a momentum portfolio composed of 20 stocks from the Nifty 500 universe for more than 8 months now, and we will be doing this for many more years to come. If you would like to be a part of this journey, this endeavor, then please consider subscribing to this channel. Before we move on to the changes in the portfolio, and there are a lot, I just want to remind you that this is your financial journey, this is your money, so please consult your financial advisor before making any investments. All the stocks that we see are just for educational purpose. I am personally invested in these stocks, but I am not asking you to go and invest your hard-earned money in these stocks. Okay, so let's just get started. So overall picture, we are still 2.8% away from the all-time high. We are yet to cross the all-time high that we reached on July 5th. In terms of the changes in the portfolio, there are 4 exits, 3 mid caps, 1 small cap, and there are 5 entries, 2 large cap, 1 mid cap, 1 small cap. Why there are 5 entries and not 4 entries, we will discuss about that. But before that, let's talk a little bit about the exits. So we have 2 exit criterion, right? The first exit criterion is anything that falls below the worst rank held of 50, which is the WRH. Anything that falls beyond the rank 50 on our screener, we kick that stock out of the portfolio. So we have been using this Momo India screener. It's a paid tool with a nominal annual subscription, but anything that falls beyond rank 50 here, you can use any subscription, any screener for your purpose. You can build a DIY screener for your purpose also, but anything that falls beyond rank 50 here, we kick that stock out of the portfolio. So that's the first criterion. The second criterion is any stock that falls more than 25% from its all-time high, we kick that stock out of the portfolio. So in terms of the 4 exits that we see this time, one exit is because of the first criterion, which is the worst rank held, and 3 are due to the second criterion, which is that these stocks fell more than 25% from their all-time high. Okay. Now I said we have 5 entries this time rather than 4 entries. Usually what happens is when there are like n exits, then we have n entries to compensate for those. But this why we have 5 entries this time is because we have the exit of a very large winner, and no need to keep any mystery, that large winner is Cochin Shipyard. Most of you would have realized. So what happens in this case is that when a large winner exits your portfolio, right, so they leave you with a lot of cash. If you deploy all that cash and the resulting cash from other exit positions in that rebalancing cycle as well, and you put that same amount of cash in the same number of stocks, then it is possible that the starting weight of the stocks in the portfolio would be very different or much larger than how some of their other peers would have started in previous rebalancing cycles, right? तो उनका starting weight ही portfolio में ज़्यादा हो जाएगा, right? To compensate for this, to mitigate this, what we can do is either you can start all of these. If you have to like keep the number of stocks fixed in your portfolio, just say if you have 20 stocks, then you have to you cannot increase or decrease it, right? If that is the condition for your investments, then you can deploy the nominal cash in these new stocks, whatever starting weight you, as per the starting weight you want to assign, and for the remaining you can deploy it in the remaining existing stocks of the portfolio जो पहले से हैं, right? The second approach that you can do, and this is what I have personally done, is instead of like bringing n new stocks in the portfolio, you can bring n plus 1 or n plus 2 new stocks in the portfolio. Mostly you have to like what you are adjusting for is the starting weight of these stocks in your portfolio. Okay, and it's not very like hard and fast, कुछ set in stone rule नहीं है. Momentum is usually a forgiving strategy, and you just have to be in the ballpark. Okay, so with this change, our portfolio has now expanded from 20 stocks to 21 stocks, and this is dynamic. Why I say this is dynamic is because this 21 can again become 20 in the future. How can it happen? So let's say there are 2 loser stocks that are exiting the portfolio, right? And both of these stocks have lost 50%. So the combined cash that they will give you when you sell off those stocks, if you put those again in 2 stocks, then the starting weight will be very little for those stocks, right? In this case, because there is a large winner, the starting weights can be high. When there are large losers, the starting weights can be low. So in that case, you can, instead of buying 2 new stocks, you can just buy 1 new stock. Okay, so that is the thinking which I've done this. And but for the foreseeable future, I feel that we are like going to continue with 21 stocks, and these are rare scenarios. You have to understand that ये regularly होता नहीं है, right? We have gone through so many rebalancing cycles. We have never changed the number of stocks. This is happening because a large winner has exited. So whenever a very large winner or a very large loser exits your portfolio, those kind of situations can change the number of stocks in your portfolio by a small margin. Like you cannot keep increasing your stocks till like 50, right? तुम्हारा worst rank held भी 50 है and number of stocks भी 50 तक पहुंच गया, वैसे नहीं होगा. You have to have some reasonable threshold. Like let's say I put a threshold at 25, right? So the moment my number of stocks starts again approaching 25, then I would have to like do some rebalancing so as to adjust the weights of the existing stocks in my portfolio. Okay. Anyway, so that's the thinking behind it. Now let's come to some exit metrics. So in terms of the winners percentage, right? So what is winners percentage? If you deploy your money in 100 stocks, then how many of those 100 stocks are winning? That is your winner percentage. And how many of those 100 stocks are losing? It is your loser percentage. And it's very like most new investors who come always have this idea that if we deploy our money in 100 stocks, then most of these stocks would give us returns, right? In real life, that doesn't happen. In real life, what happens is few of those stocks will give you returns, and very few of those winners also will drive the majority of your gains. Okay, so the Pareto principle, which is at play in most situations in life, the same thing is there in momentum portfolios, and the same is in any other concentrated portfolios also. Okay, so because we've made 4 exits, but only 1 winner was there and 3 were losers, because of that our winner percentage is down and the loser percentage is up. What this also indicates, as I said, is that most gains are coming from very few winners. Most of your stocks are losing money, but the very few that are winning, they are winning large, so they are compensating for the losers. So we can take a look at the exit metrics also. Average holding period also, as you can see, has increased to 72.4 days. So if we come here, right, so you can see all the stocks that we have exited: Cochin Shipyard, Anand Rathi, Bharat Dynamics, GRSE. And out of these stocks, 1 is a large winner, so 145% is the return. The other 3 are losers, and if we see the last 2 metrics we haven't discussed, right? So this is the average gain for winners in percentage. So this is the average return that a winning stock would provide you versus the average loss that a losing stock will provide you. Okay, and we'll come back to this when we discuss Cochin Shipyard, because this number has increased by a lot. Okay, so the last point that I want to say, and here you can see the skew towards the large caps. So the blue rectangle is just getting stronger and stronger from June onwards in our portfolio, and you can see the current distribution also here. All this is actually present in the market distribution tab also on the sheet. The sheet is public, you can check it out anytime. One last point is that there is some sector rotation that is visible towards the defensive sectors of the market. So these can be pharma, consumption, FMCG, while the risk on sectors that have been rallying for some time, they have been sort of cooling off a little. आज का जो market का scenario था, the market was buoyant, everything was bullish. We can discuss that probably in the last couple of minutes of the video. But overall, in the last few weeks, it has been seen that there is some little bit of shift towards the defensive. Whether this like shift will endure or not, that's a different point that we'll have to keep checking. But for now, there seems to be a definite shift. Okay. So the largest gainer ever in our portfolio is Cochin Shipyard with almost 146% gain, and because it has fallen more than 25% from its all-time high, the stock has exited our portfolio now. So you can see this beautiful chart here. So the green point is where we entered the stock around 897, and then we exited at this red dot, right? So the red dot that you can see here is where we are exiting. So always remember, in momentum you can never get out at the exact top, you can never get in at the exact bottom. Okay, you have to ride the wave. whenever you get some sort of confirmation as per your exit strategy that something is cooling off or something is losing momentum or losing steam, then that is when you need to get out. So the exit is always after a little bit of fall. You never exit at the top. Okay, so that is something to keep in mind. Now this is exiting because of the secondary criterion, right? So we just talked about the secondary criterion. Now we have to do some analysis on the secondary criterion, so that we will need to do over time, because this criterion can also lead to a lot of churn and whipsaw. So many stocks can actually fall more than 25%, but they have not gone beyond the top 50 rank. So they are not meeting the first exit criterion, but they are meeting the second exit criterion, and they get kicked out of the portfolio, but they may then rebound after that. Okay, so that is something that we'll need to see with many of these stocks. For example, GRSE now is not out of the top 50 ranks, but it has fallen more than 25%, right? So we will monitor the trajectory of these stocks. Although these are still out of the portfolio, we'll monitor the trajectory of these stocks, and we'll see in real time how many of these stocks are performing. In the long run, we may also see, or we may also assess whether we even need the secondary criterion or not, or if we just need to stick with the primary criterion. But then again, everything has its trade-off, right? So if you have only the 50 rank criterion, only the primary criterion, then you could be sitting on massive losses, right? 30-35% losses also you would have to endure. That's a trade-off, but the churn could be less, the number of whipsaws could be less. So the gain is that way. And also, when all stocks start falling like crazy, then the secondary criterion could help you get into cash quickly. But then if you wait for them to fall beyond 50, if all stocks are falling together, the stocks, like, relative outperformance is not there, all stocks are falling together, then the stocks may continue to remain in the top 50, right? So that is also another aspect that we need to remember when setting our exit criteria. Anyway, we were talking about the average gain percentage of winners. So that has gone up from 20.3% to 26.6%. Okay, and why this change? Why this massive change? Because if you see the number of like the average loss percentage for losers, that is also increased, right? That has increased from 10.2% to 11%. Why that increased? Because all the three loser stocks that were there this time, all of them had lost more than 10.2%, right? So the average also increased to 11%. And average gain percent also increased. Why that increased? Because we had the average of 20.3%, but this one stock that exited, Cochin Shipyard, gave us 146% gain, right? So then the average gain percentage shot up to 26.6%. So you can see this clear divergence emerging, right, between, so the average gain percentage is also increasing, the average loss percentage is also increasing. But the more gain you have, like even if you have less number of winners, if your average gain percentage is much higher than your average loss percentage, then you will still continue to make money. That's the essence of how we should think about the entries and exits in terms of momentum. Okay, now the crux of the presentation, I guess. So outgoing stocks, these are the 4 exits that we have made. So Cochin Shipyard stayed in our portfolio for 154 days, return is 146%, and it exited because it fell by more than 25%. Anand Rathi has been there for 123 days, return is minus 14%, and exited due to the worst rank held criterion. Bharat Dynamics remained for 77 days, return is minus 15% and 25% fall, which is the secondary criterion. Garden Reach GRSE remained only for 39 days. यार मतलब just a month and एक महीने में इसने कमाल दिखा दिया. So you can see 24% loss in 40 days, and then it exited because it fell by more than 25% from the all-time high. Okay. Now let's take a look at the incoming stocks. So one more thing is that you can, if you see all these stocks, right, 3 of these 4 stocks are in defense space. Okay, and once we exit a stock, it is not that we are not going to re-enter if they again come back into momentum. If they again come back into momentum, so if they are within 25% from their all-time high and they are within the top 50 ranks, and we sell some exits and they are in the top ranks, then again we will take it. Okay, we are not biased against any stock. If we are exiting any stock, we may enter it again at any subsequent rebalancing. Okay, so there is no bias that way. Now the incoming stocks, What are the incoming stocks? Most of these are from defensive sectors. So we have 5 out of these 5 except V-Guard, which is in cap goods. The other 4 are in consumption and pharma, mostly pharma. So you can see Glenmark mid cap 1 year return is 96%, RSI of 68. Granules small cap 1 year return of 127%, RSI of 76. V-Guard, this is in cap good space, mid cap 1 year return of 68%, RSI of 77, and Colpal large cap 1 year return of 36% and RSI of 80. I had never imagined that I would be getting Colpal in the momentum portfolio, but whatever stock names the screener throws up, we'll have to invest in that. I'm not expecting a lot from Colpal, but you can see the chart, it's going pretty good at this point. Now if you compare these, okay, before that let's take a look. Isko kyun chhod diya yaar? Matlab the last stock is Lupin. So Lupin again is a large cap pharma stock. Most of you would know. 1 year return is 88%, RSI of 73. If you look at all these entries that we are taking, Colpal actually has the highest RSI of all the stocks, which is kind of surprising. So probably it's the most overbought, but then it can also fall probably less than the other stocks that are there. Okay. Now if you look at the charts of these stocks, you can see a clear difference in the charts of the exits. So all of these exits, you can see the chart is tapering down at the end, right? The stock is falling. If you look at these 4, they are all are very, very close to their all-time high, right? And this is a function of the like some sort of sector rotation happening, the market moving towards some other stocks, right? So all these stocks are defensive stocks, right? Pharma stocks. So the market is moving towards them, but whether it is moving towards them like and that movement endures in the long term or not, that we are never sure, right? This like sometimes private banks run up for 2 weeks or whatever, right? So that rally doesn't sustain for long, and sometimes it can go off, like any sector can go off at any point of time. But that's why we have these fixed look back periods, right? We are assessing the Sharpe ratios of these stocks for like 3 months, 6 months, 9 months, 12 months, and even then there are ranking differences. These stocks can go out of favor very soon also, so we'll just have to keep monitoring them. But for now, these 5 stocks we have entered. Okay, so let's take a look at the portfolio today. So portfolio was the whole market was up today. Our portfolio was also up today. If you can see the sectoral indices, almost everything was positive. You can see everything is in green. The weakest today is actually pharma. So pharma that has come up as like in the last few weeks. So if you can see the strongest performance in 1 month is actually pharma at 6.44%. And the weakest performance today is pharma. So sometimes it happens that when the new energy comes in the market, right, it might try to go back to the risk on sectors, and again the defensives, there would not be much movement in the defensives, right? So today is probably an example of such a day. Pharma has not moved much. The other sectors have moved quite a bit. You can see private bank 1.65, IT at 2.89. These sectors have moved quite a bit. In our portfolio, let's look at the gainers and losers in our portfolio. Okay, so starting with the topmost one, so Power India 6.1%. We had, I think Siemens was also up. Siemens is up almost 2%. Bharat Electronics 3.3%, Oil 3.2%, Glenmark 4.75%, then Zomato 1.77%, HAL 2%, seeing like some gain in HAL after a long time. Trend again continuing its upward rally. So mostly like everything was positive in today's session. Not much to talk about today's session anyway. So yeah, so that's pretty much it when we talk about the rebalancing. So these are the entries and exits that we have made in this portfolio, and let's see how these stocks perform in the future. And let me know in the comments below if you like the video, and please subscribe to this channel to stay updated. I'll see you in the next video. Till then, take care. Bye bye.